YouTube and the group.
Yeah, we're good. We're up.
All right. So this is starting our live. It's Wednesday, 9 o'clock. A lot of you all have been kind of waiting for this, and here we are. This is going to be a good one. Let me tell you. Our last live, we had over 400 plus views and listens before we even finished. Now, right now, some of you all are listening to this on our podcast. Some of you all are watching us live. And we always say, if you have comments or questions, direct them to the Investing Education Academy group or in the comments below, and we'll get to as many as we can during the course of this live. So last week, we talked about the wealth gap between white America and Black America, if you will. Again, it wasn't a bashing or, hate mail. It was just a reality, a very chilling reality. And so many people commented on that live and that they just couldn't believe the numbers. We decided to actually do a part two. So this is going to be our part two to talk about, some of what causes and the effects and why the economic gap is as large as it is. And for anybody coming in, Leon did some research and found out that essentially Leon, you can give them the overview of last week and
so
pick up where we're going today.
What we did last week, we showed the disparity in the wealth gap, right? So we showed that the wealth for African Americans in the U.S. relative to white Americans, African Americans are 60 years behind where white America is as far as wealth. So Black America just now in 2016, using that as today, that's the data we had up to 2016, just now caught up to the wealth of white America, but back in 1962. So we're talking effectively 60 years. African Americans are just catching up to white America's wealth is, but 60 years in the past. So we're 60 years behind where white America is as far as wealth gap. And the reason we did that topic is because, everything that's going on right now with the whole Black Lives Matter movement, the kind of social injustice that's going on. And we looked at it as, from because, we were on the finance side, we looked at it as, well, how can we address this topic? But kind of around the things that, the things that we discussed, which is investing. And what we found out last week was one, African Americans are 60 years behind white Americans as far as wealth. And then we kind of found out why. And we found that African Americans, by and large, have their money in very low paying assets. So assets that are dependent on interest rates, which are typically bank accounts, savings accounts, and some debt, which could be business debt. But because from the numbers that we saw, it's probably just more like credit card debt. So African American money is tied up in things that do not pay well. There's not a high return on investment. Conversely, white America has their money primarily in real estate, land, and the stock market. And as we know, we always say the stock market pays about, on average 10% per year. Real estate, some stats I looked at recently, real estate can be anywhere from as low as 5% to up to maybe 15% per year on average. So you look at checking and savings accounts for African Americans that pay right now, you're lucky to get 2% in a savings account. That's really high for your savings account. But checking account pays essentially nothing. And that's where the lion's share of African American wealth is. Checking account, savings account, car loans, and debt, things that do not pay really any return. Whereas again, white America has their money in stock market, real estate, and land. So that was kind of the issue we talked about last week. So this week we said, okay, well, let's do kind of a part two based on the feedback we got. And we're going to kind of point out some of the things we talked about last week were kind of in abstract. So we're going to show some detail this week on some of the numbers we talked about last week. Yeah,
so again, we're going back to that space where, this information is so important right now, not only because it relates to where we are, but it's going to relate to where we're going. So this is one of those conversations like right now, we're planning another 30 years out, because right now, as it's laid out, according to the research we found, the wealth gap will not be eliminated for another 230 years if things all get corrected today. And so, or as it was in 2016 up until where our research stopped. And we all know that it hasn't been corrected. So considering that it's not corrected, the projections could be over another 300 years before Black wealth catches up to white wealth in America unless we make some changes today. And to that end, Leon and I have really, we sat down and we thought about, what is our role in this? Like, what are we doing to lessen that gap? And we're providing this information to you all. And it's up to you all to share it with your friends, family, with your networks, to kind of start the conversation of where is our money? And today during this live, and if you're listening to this podcast, we're going to show you what happens when you leave your money in various places. Also, a big reason for the wealth gap was entrepreneurship, or the lack of entrepreneurship in the African-American community. Much of that is going to be tied back to money, because if we don't have the proper resources to start our businesses, of course, number one, we aren't going to start them. And then two, even if they start them, the failure rate is going to be higher for us than it will be for most ethnic races, especially in this conversation, we're talking about white America. And so, take a second, send this to 2 or 3 people, share this podcast with somebody because we're going to dive into the numbers. In this particular day, I'm going to lead off with it, and we're really going to look at entrepreneurship. And it is, again, sadly shocking of some of the stuff that you're going to see shared during this live. So I really looked at small biz trends and their information on startups. So a couple things to think about. They said 69% of US startups start in their home. That's completely consistent with how probably we know most people to get started. We're going to start in our homes, see if it's viable. Once we realize it's viable or not, we then move on. Now, this information was taken up by the National Association of Small Businesses up until 2017. So it goes through the percentages. We're going to share the links for this inside the Investing Education Academy group on Facebook. So if anybody wants to get these numbers, again, it's going to be inside Investing Education Academy group on Facebook. The gender bias here is unbelievable. 73% of businesses are deemed to be started by 73% started by men, 25% started by women. And in that stat, we go down and we look at the age ranges. Age ranges I'm not going to pay a whole lot of attention to, but just to kind of breeze through it, between the ages of 50 and 59 years old is 35%. 40 to 49, 25% of those people are starting businesses. 60 to 69% of those individuals, 18% of those individuals start businesses, account for businesses being started. Let me say it correctly. Between the ages of 30 and 39, they account for 14% of the businesses being started, and 18 to 29 account for 4% of businesses started. And then you have 70 plus account for another 4% of businesses started. Now, what this tells me is essentially most of the people starting businesses have already accumulated a certain amount of wealth that gives them the knowledge and resources and connections that give them the confidence to go out and start these businesses. So interpreting those numbers, that's what's pretty much clear to me. Lee, do you have any thoughts about those numbers?
No, I agree, because what is that, about 35 or what is that, about 70%, 35, about 70, 80% of the age range there is above 50. Sorry, it's above 40. So yeah, those are people that have been in the workforce for a while. Some are even maybe in retirement or near retirement. Yeah, but definitely have accumulated a lot of wealth and work experience leading up to that. So yeah, I agree.
And so you take this number and you compare it with what you're going to see later. It's going to be a great conversation we're about to have. So 33% of the people starting their own businesses have GEDs or high school diplomas. 18% have associate degrees. 29% have bachelor degrees. And 16% have master's degrees, and 4% have doctorates. So what, again, that's telling me is, or what I'm interpreting from those numbers, is that as people really advance their education, they're getting more and more sticky to their jobs, their vocation. And it's a high probability that when you start looking at the doctoral level, you're so specialized that it's probably easiest to work in an institution that's going to pay you handsomely for whatever it is that you do. So the necessity for entrepreneurship isn't there. Now, when I look at 33% of people in high school, have a high school degree, that's telling me that probably there's a little desperation, like, you know what, I got to start a business, or somewhere in high school, they decided that that was kind of, they knew their vocation, or, you know, they didn't have enough money to go to college. And so I don't know the high school GED percentage, and I really can't guess with that. It's a lot of things it could be, but it is telling them when you get to higher degrees, it's less entrepreneurship occurring. So now let's talk about what really relates to what we talked about last week. And I'm going to highlight this: ethnicity of those starting businesses. For those of you all listening and can't see the chart, for those of you all who can't see the chart, there are 71% of white America accounts for small businesses being started as of the time of this research. I'm gonna say this again: 71% of small businesses being startups happening, let me say that, startups happening in the United States of America are being started by white Americans. Hispanics then come in at 6%. African Americans come in at 7%. Pacific Islanders or Asians come in at about 11%. And then this particular research has other listed at 5%. So although all those are important, we're going to focus on two right now. White America is accounting for 71% of startup businesses in the United States. Black America is accounting for 7%. This is
another reason that's shocking is because African Americans make up roughly 12 to 13% of the U.S. population. So they're not even, African Americans aren't even keeping up with their population of society as far as starting businesses. They're actually half of it. Yeah. Make up 13, 14% of society in the U.S., but only starting 7% of the businesses. That's, again, lends to the wealth gap we learned about last week.
All these things tie directly back to the wealth gap, because you have to think small business is the backbone of the U.S. economy, right? Mm-hmm. So that means that white America is at the forefront of that backbone. And so who will banks, who will lenders focus on? It's going to be the majority, because that's where the money is. Until we get our money up and we're willing to, pursue entrepreneurship or, turn that side business into something that's legitimate, that you're really, trying to grow, is no way to catch up. There's no way to catch up, because you can't invest when you're barely surviving. It means it's going to be limits to what you can put into the market. And we have to figure out, like, what is it in the business community? Where are we spending our dollars, And how are we educating that next generation to say, you know what, you all can be entrepreneurs. You can go out there and start these companies. Because when you start a company, it's the biggest equalizer. Entrepreneurship is a huge equalizer, because now you can determine how much you make based on how hard you're going to work, or how efficiently, or how strategic, or a number of other things. But when you work for someone, they're going to tell you how much you're worth. Mm-hmm. And that's it. They're going to tell you how much you're worth, and you can agree or disagree. But that check that you receive, that's the evidence. And
well, the thing is, the agreeing or disagreeing doesn't even matter, because you can disagree all day. But if they say you're making 40,000, you're making 40,000. You can disagree, but you have absolutely no say in it. So whereas, like you're saying, if you have your own business, you can then determine, your own salary. You have some level of control. Real quick, I just want to say another thing. Hispanics, Latino at 6%. That's actually even more shocking, because Hispanics, Latinos make up roughly 23, 24% of the U.S. And they're at 6% of entrepreneurship. So that's even more striking than the African American number. So yeah, and also just real quick, the Asian number is 11%. And I think Asian Americans are like, I don't know, between 5 and 10%. So they're either right on par or overperforming their number, whereas African American Hispanics are way underperforming their number as far as starting business. And again, this all lends back to the wealth gap.
Yeah. And, this report really goes on. We're going to share this in the links to talking about the causes for some of the failure, right? No marketing, 42%. Ran out of cash, 29%. Not the right team, 23%. Let's stop at ran out of cash, 39%. if African Americans aren't getting loans, aren't being represented at banks, aren't being afforded opportunities to get cash, then it's almost impossible for them to have a successful launch to their business because they don't have the resources. And without those resources in place, everything's an uphill battle. And this is just adding to the gap. And right now, we're going to go into one other statistic I just found to be like, wow, this is interesting. From the people who are starting these businesses, as of 2018, this research was done, personal funds accounted for 77% of the funding for their own businesses.
Wow.
Now, you think about this. Now, white America is accounting for 71% of startup companies happening. And if 77% of this money is coming from personal funds, this goes back to what we talked about with generational wealth. They have the resources and the wealth has been passed down for them to now venture out, be entrepreneurial, and try a hand at a business. Because they know 77% of this money is coming from their own funds or friends and family, let's call it that, even though that's actually separate according to this chart. Bank loans are 34%. That's not that high.
At all. I would have thought it was the other way around. I would have thought 77% bank loan, 34% own money, but it's the exact opposite.
Yeah, and you looking at now, okay, so we started a company, and I'm just, quickly to say this, 77% of your money is coming from your personal account, right? And then for those individuals who make it, like the average business goes about 5 years before it's determined if it's going to succeed or fail. The reason why it goes 5 years, people don't tell us. And we always hear, oh, your business will go under in the first 5 years, but why? Because most people, and this research actually opened my eyes to why that is now. When most people start their businesses, considering they're over 40, because that's where the majority was, over 40, they've accumulated a certain amount of wealth inside of their 401ks, 403bs, 457 plans, TSPs. So most individuals in that age bracket have accumulated about 6 years of income in their TSPs and various retirement accounts. And some have between 6 months and a year's worth of liquid assets available. So now you take those two numbers, and it makes complete and like utter sense that 5 years is the number, because what you're going to do is you're going to burn through cash on hand first, because 77% of funds are coming from personal effects and personal accounts. After you burn through it, if you have between 6 to 7 years worth of income in your retirement accounts and you're going to use it for your business, you get hit with the 10% IRS penalty for early disbursement from a retirement account. Then you get hit with taxation, regular ordinary taxes on any gains. So that's probably going to pull you down to about 4 years worth of income, right? Survival money for your business. Between the 2 years you had, say 1 to 2 years you had saved, about 4 years you have in retirement funding, that makes up 5 years worth of money that you're pouring into a sinking ship. And like when I did the research, I was like, this is where the gap, this is why that gap persists, because now not only is that failure rate about as little over 50%, that means that you wiped out your retirement and you're going back to survival mode when you clearly left the job to pursue entrepreneurship. We have to look at our resources, where our money's coming from, how are we leveraging money, how are we passing down money. And for, the parents watching this, think about your kids right now. The best way to stop this is the generations after us. We want to get to a place of success, and this is why IEA exists, looking at where we're putting our money. Leon's about to dive into that wholeheartedly. And when you look at where you're putting your money, and we're going to give you some resources during this live that I hope you all go to Invest in Education Academy, the group on Facebook, because we're going to put the links to this information up. Now, with that being said, with that being said, you got to look at how you save. And that's what Leon's about to go into, is looking at how we saving our money, because that's going to give us the money to then fund these ventures. And then what does your network look like? Is your network prepared to support you as you start your company? I don't know. That's the question that I hope all of you all ask yourself, because it's a very important question. So I'm going to jump into, Leon, do you have anything to say about this?
No, just, shocking, both shocking. One, the numbers on the percentages of the different ethnicities that start businesses, and then to see that 70% of money for small business comes from people's own pockets. That's shocking to me too.
Yeah.
Again, African Americans don't have that money, can't start the business, and that's why that number for us is so low.
Yeah. So you want me to go into slide 1?
Yeah, for me, yes. Yeah. Okay. So what I'm gonna cover now is so last week we covered again the wealth gap. African Americans are 60 years behind white America as far as wealth. And the big reason, so one thing I found, so I just coined this term I'm calling the return on investment gap. And you're going to see why in a minute, but the return on investment gap is make the trademark that. The return on investment gap is actually one of the big reasons why the wealth gap exists. And this slide here will kind of get into it. So what this chart is showing you, this is the Fed funds rate, right? So with the Fed, effectively what this is the interest rate chart for America going back to 1950, right? So left side of the chart, you see from 1950 to 1980, interest rates were rising, right? So that was great for savers. Anything that dealt with interest rates was getting good return, getting decent return. I mean, you see it went from about 2% up to near 20% in 1980. But you see, since 1980, interest rates have absolutely tanked. I mean, they'll get a little pop and then they'll drop, get a little pop and drop, get a little pop and drop. And they absolutely bottomed out during the credit crisis or the Great Recession in 2008, 2009. So you look around 2010 there, you see where rates were basically at zero. And they're not actually literally at zero. So when the Fed lowers rates, when they take it this low, it's typically like 0.01 to like 0.25 is roughly the range, but effectively zero. You're not getting any return. So the credit crisis, rates went to effectively zero. Over the next decade, between 2010 and 2020, they kind of ticked back up a little bit to about 2.5%. But then Corona hit. We all know what's happening now, and Fed cut rates again about a month ago back to zero. So right now, so the reason I'm showing this is because what we showed last week was that African Americans, on average, have their assets, their money, in interest-bearing accounts, interest-bearing assets. And the problem with that is, you see on this chart, interest rates have been dropping dramatically the past 20 years, about 20 years. And so if African Americans are putting their money into something that's dropping, that's contributing to the wealth gap. And as we said last week, white Americans putting their money in things that are going up: stock market, real estate, and land. So African Americans are fighting this crazy uphill battle, trying to put as much money as they can into checking savings accounts, and they're getting effectively no return on it, right? So keep this in mind. So we see here from 1980 to today.
And real quick, Lee,
Hmm?
let's talk a little bit about inflationary pressures right now. So many people with COVID, civil unrest, a need for equality in the United States as a whole. They're focused on health, they're focused on equality. And quietly, these inflationary pressures are pushing in and getting a foothold in the grocery stores. And people aren't noticing they're getting a foothold in goods being produced. And so, eggs don't cost what they did 3 weeks ago. And so where inflation normally goes at a slower rate, it's been hyper accelerated. And because it's not under the realm of inflation, we're looking at it like, oh, it just costs more because there's nobody there. Because of COVID, they have less workers, so they're working harder. There's nobody driving the truck, so it costs more to get trucks. These things necessarily won't change when this goes back. And also, what's going to happen is some of these producers of goods going to realize they can charge more. And they're going to charge more. Toilet paper, water, all these things normally that have a very slow crawl to increase numbers are like being hyper accelerated during this time period. And because we're just so excited to get it, we're not looking what's happening in the marketplace, which means this chart is hyper accelerated at this point. So when you put your money in a bank account and you're getting what Leon is saying is like 0.0%, maybe two. All of a sudden you come out and you're like, I want to buy a hand sanitizer. And all of us know hand sanitizer used to be like free,
Right.
or you get it for like $1 at the front. That small bottle of hand sanitizer that used to be on the impulse buying rack is now behind the shelf. Like you got to request it, and it's probably like $10 to $12, $5 for the really small bottles. When you look at when you're buying eggs, and it was probably, I don't know, $2, $3, $4 for a dozen or so. It's now like 5, 6. And this is huge because it means it's eroding the buying power of your dollar. And we're so caught up in everything happening, we're not seeing what's going on in our communities, in our stores. And so when the smoke does clear, you have to make more money just to live with the means you were before this all started. So, and Leon, the next graph is going to be pretty telling on what happens to your money in these inferior accounts.
And yeah, Brent makes a good point. So that's a really good point about inflation. So what this is showing is that, yeah, as Brent said, inflation runs about average 2-3% per year. But that's a good point. Right now, I just saw a report the other day that said groceries are up 15% since COVID, since mid-March, 15% for groceries. And your interest rate, as you see from this chart, is dropping. So the money, your quote unquote investment is going down in value while the price of goods are going up. So you're upside down. Prices are going up, and your investment is actually going down in value in return on investment.
You're losing buying power at the fastest rate ever. Like right now, the erosion of your interest is unbelievable. And Beverly just put a post. Shout out to Beverly because she's super supporter. She was like, "This is so true. If you no, let me see. Actually, that was Shaniqua. Shaniqua, she said that it's so true. If you online shop, you can see trending prices of groceries going up." And then Beverly said, "I'm noticing it as well. I just paid $19 for a sandwich that normally costs $13 pre-COVID. Like, geez."
Yep.
And so these small businesses that have been hurt, that have been, whatever that caused them to experience economic loss, they're trying to make up the difference. And especially in the small business marketplace, because their store hasn't been open for X number of months. You go in and buy some bubble gum, it went from $1.20 to like $2.10. And if your money is in these inferior investments, people, this is why we do what we do. This is why we're spreading this message as if it's gospel, because someday it's going to hit, and people in our community are going to say we were prepared. And those that are choosing not to listen, or maybe turn the blind eye, or not listen to these lives, we're not charging for this. Like, this is information really to say you need to be prepared. The change is here. It's not coming. It's not projected. It's like right now. And if right now the change is happening, but you're still saving your money all the old ways that you did before, you're losing. And your children are losing, because what you're going to see from the chart is what happens in the future.
Right. Yep. So again, this chart is just showing you, again, the if you're primary in interest bearing accounts, savings, checking for your investments, you've been losing the last 20 years. And so, yeah, Brent, you go to chart 2. Okay, so what this chart is showing you, playing on the back of the other one. So this is showing a savings account that's yielding 2% per year, right? So, and it's going over a 10-year period. So in year 0, which is the first year, you have $10,000 in there, deposit in this account. And over the next, so this is showing compound interest as well. So the interest on this is compounding year over year over year for 10 years. So it goes from 10,000 in 10 years, you grew your money from $10,000 to $12,189.94 for a 21% return, right? So, that sounds okay. 21%, decent, not bad. You didn't lose. You made more, more, you did 21% in 10 years versus 2% in 10 years, which kind of looks good. But I'm gonna show you why this is actually terrible. It's embarrassing and it's sad. And on slide 3 here. So this chart is a chart of, let me step back. The chart before with the interest rate in a savings account was essentially Black America. Black America has their money in savings accounts, typically like this one, money in savings accounts, put in there at year 0, 10 years out, they've grown their account by 21%, right? Not bad, but really it's terrible.
It's horrible.
This is
again, bad.
Yeah, this chart is Black America, right? So now go to the next one, Brent. So this is now white America, right? So they have their money in higher earning assets. This is a or sorry, Brent, go to, yeah, you got it. This is a yeah, I got it. This is the stock market, right? Earning 10% per year on average, and this is going out 10 years. The same 10 years, the same $10,000 that Black America put in their account. Same here for white America. They put into the stock market for 10 years. Now look at the difference. That $10,000 grew from $10,000 to $25,937.42 in the same 10 years, right? For 160% return in 10 years. Remember, Black America's money grew at 21%. White America's money grew at 160%.
Over a 10-year period.
Over a 10-year period, right? And this is where I came up with the ROI gap, or the return on investment gap, because the difference between 160 return for white America and the 21 for Black America is 139%. So what that means is white America is earning 139% more on their money than Black America. That is unheard of. I mean, I've never heard anything like that. And that's why unless we close this gap, forget eliminating the gap, we just need to shrink it some, right? So instead of Black America earning that 21%, that needs to jump up to 50, 100, 120% per year over a 10-year period, just to even close the gap. So this shows the striking level of disparity between white America and Black America on the money that they earn. Again, the return on investment gap, or the ROI gap, is 139%. White America is earning 139% more on their money than Black America. And that's one of the biggest contributors to the wealth gap.
And Leon, that's going to take us perfectly into this rule of 72, right? A lot of people ask about the rule of 72 and how it works. And essentially the rule of 72 tells you how long it takes your money to double at various interest rates. And so we found this calculator. We're going to put it inside the Investing Education Academy group for anybody who wants to, learn this or use it really. So let's look. If your money's at 10%, what Leon just talked about, only thing you have to do is put in 10%, hit calculate, and it tells you it takes you roughly 7.27 years for your money to double. So at 10%, roughly 7.27 years, right? So let's just say 7 years to make it easy. Now, Leon just said 139%, and let's just see what happens. You are less than a year for your money to double. So that means every 8 months, your money's doubling. Like with that gap, that type of gap. Now, it's more to go into it to do the math than what I just did, but just think about, okay, if we're Black America, we're at 2%, right? And we do the calculation. That's 35 years it's going to take your money to double. Again, if you all, watching this want to throw in some like, hey, what about 10%, 12%? I will run the calculation right now. But now we're talking about, because you're in an inferior product, it takes you 35 years for your money to double. Now, if you're depending on that money to start a business to increase your, income, is that going to happen at 2%? You're just working hard, and we have to learn. We have to learn how to make our money our employees. And until we learn to make our money our employees, we are going to lose. And I'm telling you, I'm not going to lose. Like I am not only learning to make my money my employees, I'm getting training on how to get my employees to work harder. And that's what IEA is doing. We're helping train you all to efficiently use your workforce. Your money is your workforce. How are you managing them? The bank is vacation. In your house, I mean, that you just fired them. Like they're no one's working for it. You fired off everybody.
Yeah, if the money's sitting in your house, there's no return on it. So
there's nothing. They're not working.
And then with inflation, it's actually losing money per day if it's just sitting in your house. I mean, really, it's losing money if it's sitting in a checking account.
It is.
It's almost breaking even if it's sitting in a savings account. In some instances, if you're at 1.5, which is more the average, you're actually losing money. So unless your money, again, is in something that's, I mean, like I just said, groceries are up 15% in the last 2 months. If your money, even if your money is in the stock market on average at 10%, based on groceries, you're losing money, right? I mean, now that 15% for groceries, of course, isn't normal. That's just kind of what we're going through now. But it just shows how your money has to be working for you and has to be earning, these returns of 10, 20, 30, 40% a year, if not every few months. I mean, we have people in the group, in our Facebook Live group, in our Facebook group, that are some are up 80%, some up 20%, some up 30%, because they realize, one, to follow our picks and jump in on some of the things we're saying, and two, that you have to earn more money than inflation. You have to earn more money than just your job to get ahead in this world, because you will be stuck. I mean, again, the ROI gap is 139%. White America makes 139% more return on their money than Black America. That is a staggering number.
To that end, we had one person. This isn't information. It's just solely for people who don't have a lot of money. This is for everyone. Like, the market is for everyone. And so it's those that understand that they have a certain type of capital that they can invest. Leon, it's called
risk capital.
Okay. So if you understand your risk capital, then that's what you're really investing in. You're not losing sleep, right? But at some point, and I'm glad I'm no longer a licensed financial advisor, because I can say this. At some point, you just got to take the jump. Like, even if it means using money that you need, because the way the world is going right now, if you just try to hold on to it because you're scared, that fear is going to put you further under. Mm-hmm. And you have to figure. And again, if you're investing in real estate, great, get at it. If you have the money, if you have the risk capital, if you have the backing, if you have the support to do it. And you don't always have to be the person who's fronting the cash for it. You could just be the person putting the deal together to get something on it. But get into circles of people making money, because I'm telling you, when this COVID has just started, we're only 3 months in. And so we still have to deal with the rest of this year. And if prices have increased 15% in 2 to 3 months, mm-hmm. I pray that you have a way to make more money.
And on that point you made about, so I just thought about something. So you said about real estate, like, real estate is great, not knocking real estate at all. But real estate has a high startup capital, right? Stocks, the market literally has, so this is the only asset in the world that has no startup costs whatsoever. There is nothing you have to pay to get into the stock market. Commissions are now gone. If you're at a broker that you're paying a commission on, get off of that and move to TD Ameritrade, Robinhood, Cash App, Stat, whatever.
E-Trade.
E-Trade, yeah. E-Trade. E-Trade. So the market is free. Literally, it's free. And Brent, if you can go to the last slide. Yeah. So this slide here, I'm gonna show you something about dividend stocks. So dividend stocks are amazing, right? So as I said, the market is free. It costs you nothing to invest in the market. There's no other asset on this planet that's basically gonna give you free money and charge you nothing to get into it, right?
Leon, real quick, before I go into this chart, I do want to show one other thing. All right. With this rule of 72, this works in reverse for your interest rates, people. So if you have a credit card and you're being charged 14 or 13.99%, you can come here and put in 13.99% and then hit calculate. Every 5.2 years, your debt is doubling. And so it works the same way against you. So if you want to make a decision, if you're out and you're moving about and you're like, oh, they just told me I can get 17% interest rate on this. Is that good? Is it bad? What does that mean? You for whatever reason, you're just having one of those situations where you can't think it through on your own. Remember IEA, go back to the IEA Investing Education Academy group on Facebook and pull up this link. You can put that number 17% in and realize, oh my gosh, every 4.4 years that money would double. Now, how much is that money? Is it for this card that I was about to buy with a credit card, which I hope no one ever does? But, it showed that what we're spending our money on are non-appreciating assets. Mm-hmm. So in order to make good decisions, use this chart in reverse, but also look at it like Leon said, there's no cost to get into the market. And, again, most brokerage firms now have eliminated trade commissions. So you can get in with small amounts of money. And what I love about this particular site is if you have a problem and you're like, you know what, I have $13,000, I need it to double in 4 years. What interest rate do I need to get? It tells you you need to get to 18.29% on that money in order for it to double in 4 years. This is a resource that we went out and found, and we looked at a lot to put back in a group for you all to now start understanding your money. You can literally have a conversation with your money through these two calculators. And so, we're going to jump back into the dividend chart for Leon, but I just wanted to point that out. If college is coming up, and for your kids, you have 11 years left before college, and you need your money to double, how much interest rate do you need to get? 6.5%. And what that does is, from a consumer standpoint, if you walk into a bank to get a certificate of deposit, which I hope you don't do, but if you're walking into a bank to get a certificate of deposit and they say, oh yeah, great, we have amazing rates, they're 4%, you already know, because you're now an educated money consumer as a result of this conversation. And you can say, you know what, I know I need to be at least 6.5. For that reason, I won't move forward with this. I'll keep looking for something that will give me at least 6.5. So just know that we didn't look up these resources fly by night. These are resources that you literally can use to help you tomorrow. So
hey, Brent, scroll back up to the top.
Yep.
And so 17%. So it's going to take 4. So that's interesting, because if you think about that, so 17%, which a lot of cards charge, it's going to take you 4 years was that 4 years to pay it off?
Yeah. Well, no, 4 years before the debt doubles.
Oh, before it doubles. Okay, got you. Okay. So, but if you think about it, if you only pay the minimum amount on that, that's why people never pay off the cards, and that's why they're paying all this money in interest, because if you're paying essentially like you're not even paying. If you pay the minimum, it's almost like you're not even paying any money on it. And in 4 years, that $1,000 can turn into $2,000-$3,000 for that same reason. So yeah, that's crazy.
And don't forget, like like Leon said, if it was 10,000, I went up. If it was $10,000, and in 4 years, that 10,000 gonna be 20. In 4 more years, it's going to be 40, not 30, 40. And that 40 in 4 more years is going to be 80. So understand how that works. It's not, you want that on your side. You don't want that working against you. Right. And one of our quick stories is we had a one of our investors or members in IEA who started kind of really getting serious about investing with Leon and I. They're a serial entrepreneur. This isn't somebody who doesn't have money. They just realized 10,000 shy of what they made the entire year in one of their businesses, just in the market, in their appreciation of their account.
In 2 months.
2 to 3 months. They called us like over the moon. And it's these things. This is a person who just, they're not unintelligent about money. It just wasn't on their radar. They grew up putting their money in banks. It seemed like the right thing to do. And in 2 to 3 months, and listen to this story, in 2 to 3 months, they made 10,000 shy of what one of their companies made the entire year of 2019.
And that's by putting their money in the market, investing in stocks. Mm-hmm.
Now, right now, you're going to see appreciation that you're not normally going to see in the market. And Leon and I are very clear about that. The market was depressed so much that it's slingshotting back up. But regardless of whether it's a slingshot effect or not, the market still is going to outpace really any other traditional savings method that you can, conceive out there. So just make sure you put your money in the right place, and we're going to look at that now.
So, okay, so this is, so you see at the top, on the left-hand side, it says S&P 500 return. So this is over 69 years, right? So, Brent and I always say, the average return of the S&P 500 or the market is 10%. So you see that it's 9.14%. So you can't see all the dates. It goes from 1950 up to 2019. But I, couldn't fit it all on the screen. But so over the last 69 years, the market has returned on average 9.14%. We'll just say 10%, right? Now, if you look to the middle column to the right, that one says S&P 500 69-year total return. So what total return means is the appreciation of the market and dividends, right? So you're getting the market itself rising, but on top of that, you're getting the appreciation that you got from dividends. So you see the total return for the market is 12.7, or we'll just say 13%, right? So to the right of that in green, what they're showing you is that, so it's showing the difference.
What's that? I gotta try to pull it up, but you can describe what it was showing.
Okay, so what it's saying is that investing in dividend stocks can add, well, what it's shown over the last 60 years has added another essentially 4% return on your investment, right? So, and remember, that's you did nothing for that. Only thing you did was you bought stocks. Not saying all stocks, but you bought stocks that have dividends, that were dividend payers, right? So you earn an extra 4% for doing nothing. Remember, checking accounts pay nothing. Savings accounts pay, if you're lucky, 2%. Just by buying dividend stocks alone, if it didn't even move, you made 4%, right? Above what the market returned. The other powerful thing about that is it pads returns. So if you had made, say, 10% a year, you actually made 14% because you got that extra 4% from the dividends. So, and this isn't a fluke, right? This is 70 years worth of data. This isn't like some outlier year where this happened. They're showing over the last 70 years on average, if you invest mostly in dividend stocks, you're earning an extra 4% on your money. And in numbers terms, if you take $10,000 or if you take $100,000, you're talking about an extra $4,000. Or on $1 million, you're talking about an extra $40,000. So these are real world money. It's real world dollars we're talking about. And you can earn an extra 4% on average just by investing in dividend stocks. So I just want to point that out that because we're saying, look, if we can find return any way we can and move away from the low ROI investment assets, dividend stocks is one of the best ones you can do, because again, your gains are going to be padded on average by about 4% above what the market returns.
Yeah, and this information that we're providing to you all, we want you to understand that we are very careful when we say the words that we say, and this isn't information that's true right now. These lives are literally timeless. This podcast you can listen to next year, and it still holds true. The numbers may be different on some of the stocks that we're actually looking at, but the concepts have been in existence before we did this live, and they're going to be the same concepts after this live. And they're the concepts that white America is doing today. They've been doing historically. And this is the concepts that Black America has either no knowledge about, fear of, or a desire just to stay where they are and where we are. And I'm like, you know what? I'm bucking this trend. And so you oftentimes hear me like fight between we or them, like when I talk, because I refuse to let my family go through this. And as a licensed advisor, when I was that, I'm not anymore, I literally heard families or people in our community say these words out their mouth, and it made me just want to get up and leave the house. Well, why should I leave them that much money? Nobody left it for me. And why would I leave them that? That's going to make them spoiled. If I leave them that, they're not going to understand hard work. I mean, like, I can go down a list. Like, it's tattooed. It's the worst tattoo you could ever have inside your brain. And because of that, I've worked harder to work with parents, especially those who have kids, to let them know this wealth gap happened because of some of those parents I heard utter those words. And that's what's going to perpetuate this wealth gap. And not only that, those are also some of the people out there protesting, which makes no sense, like, at all. This is me on my soapbox, my little rant. They're out there protesting, and then they're coming back home saying, I want you to grow up harder than what I did because it's going to build character.
But doing nothing to achieve that.
Yeah, doing the reverse. They're
right.
Like purposely spending down their assets. They're purposely not taking care of their estate planning. How many people watching this, listen to this? Please, I challenge you, do you have an estate plan done for your family? And I'm pausing. This is a pregnant pause. Do you have an estate plan done for your family? How many of you all listening to this have the large chunk of your money in a savings account, and right now you're rubbing your chin and you're rubbing your head like, ooh, they're talking to me? Mm-hmm. How many of you all went to a bank and somebody behind the window said, hey, we have this CD today. If you get it, we're gonna give you 2% over the, and then this is one of those insider secrets that you should know. When you go get a certificate of deposit, a CD at a bank, it serves a purpose. But in the finance world, when we're in the brokerage house talking about who's doing what, we literally we used to call those, I'm not there anymore, certificates of death. We like, oh man, we knew somebody got a certificate of death today. And we were like this makes no sense. It was comical. Like, why would they do that? And it's locking us into this mindset that the banks are safe, where our money's at safe, and it's not. And you know what? The other thing too is whether you have your money in the market or not, and your money's in the bank, your money's in the market. You're just not getting the money for it. Because I promise you, the dollar you put into the bank isn't the same one they give you back. They're giving it as loans where they're getting a higher interest rate than what they're paying you. They're giving it as first-time investments for people who are doing businesses, which is we saw 70% of white America, or the 71% of the startups are happening by white America. 7% is happening by Black America. That's insane.
And only 6% of Hispanic. And so one last point on this is that, so as we know, we can't, I mean, part of the wealth gap, probably maybe the biggest portion of it is income inequality, right? So we can't, but the thing is, we can't control what, Microsoft, Home Depot, Bank of America, Chevy Chase, we can't control what they're going to pay us. They're going to pay us what they pay us. I mean, that's a whole nother debate and social issue as far as income inequality. But what we can control is the paycheck, is the money they do pay us. So when they pay us that 60, 70, 80, 100 grand a year, we then need to take that money and put it into assets that are going to give us a higher return than inflation, give us a way higher return than a checking or savings account. We control that. Like, we can directly say, I'm not going to take 2%. I'm going to look for 20%. We can directly do that. And that's the only way. Well, not the only way. That's one of the ways we're going to shrink that ROI gap. Remember, white America is earning 139% more on their money than Black America. And that's primarily because our money is sitting in checkings and savings accounts, where is in real estate, stocks, and land.
And business.
We're turning huge amounts of money. So we then think about it as, we can't control income, but we can't control our investments. The money we get from our jobs. And as Brent, you read my mind, Brent. Now, because I was, we're all about risk capital, risk what you can. But looking at these numbers, and like Brent said, looking at your children in the eye, if your risk capital is 10 grand, and you're like, okay, I'm gonna use half of that, you may want to think about using all of it. Because if you only use 50% of it, you're cutting that gain down by 50%. Is it more risky? Yes. I mean, again, Brent and I are not financial advisors. We're not telling you what to do with your money, but we're just pointing out, again, African Americans are behind 60 years behind whites as far as wealth, and we earn 139% less than white America. Something's got to be done. It can't just be kind of a patchwork and kind of crawling. We really got to go big and go aggressive with this. And as Brent said, this is not a knock on white America. It's not a knock on white people. It's just a fact. We're just stating straight facts. And the fact is, we've got to do better. We've got to be more aggressive, and we've got to have our dollars work way harder than they are in checking savings accounts, in car loans, and in debt.
Yeah, and I'm personally saying it. Like, if you have friends or even associates in white America who are doing really well, talk to them about what they do with their money.
Right.
Have those conversations. When you go out for a beer and you see some people talking, just jump in the convo. I mean, the reality is, we have to do something different, and we can't do something slightly different. We have to do something drastically different. And I'm telling you, if you're a part of Investment Education Academy, drastic is coming. And what we're doing is we're bringing this information and the resources we're about to pour in. If you think these lives are good, you should be in our platform. And we say that because for us, it's an additional revenue source. Because we're like, you know what? We need to increase our revenue sources. We're in the market, and we still see that. We're just making sure that this is, to us, this is a socially conscious business. I mean, that's really what IAA boils down to. And in that space, if it's cool if I give a little teaser to it, if you will. Can I talk about one of the membership platforms?
Yeah, do that.
So one of the membership platforms, our lowest membership platform, we were going to have it $250 a year. We have now made the decision that platform for the year will be less than $100. So if somebody wants to really go in deep to the framework that we're building, we don't want to isolate anybody. And so we're making it our mission to not only talk about it and not, to say, well, what are you all doing? Because you should question, you should absolutely question us. And you should question whoever your banks, you should question everybody who's addressing your money. Because in the end, you need to be an educated consumer. And so, in one of the spaces too, we talk about solutions, and this is just a plug, and I'm gonna stop. But Attorney Beverly Winstead just put her link up to irshelpattorneys.com. It's in the comments below. And the reason why I'm bringing this up, because her firm actually does tax planning, number one, and then two, estate planning. People, we have to get our estates up. And, insurance inside of your portfolio is one of the best ways to leverage money. Like, and that's not the fun money. That's not money that's like, ooh, weed is the sexy. It's not. But it's where right now is the largest transfer of wealth that has happened in history. And that is because of insurance. It's not because of anything but insurance. Anything but insurance. And so you can do the research, you can look up the numbers. I've done it. It's because people are dying and they're leaving insurance money to their heirs.
When we say insurance, you mean life insurance? Life insurance.
Yeah, okay. Because COVID-19, I mean, the reality of where we are, we just had, 110,000 people in the US die so far. And, even at 30% of those people having life insurance policies that are over $1 million, you're getting into some very serious numbers of wealth transfer. It's going to be in the trillions. And so when you're looking at, it'll probably be in the high billions. But anyway, billions. Yeah, billions. And so when you look at like where you settle in your life, and especially if you have people you're trying to leave stuff to, don't play around. Make today the day. Hopefully you go, I listened to Brent Leon and they caused me, and we get those texts constantly. Like, I listened to you all and I finally did it. Or, you know what? You all look like you really care. Or I can't believe how intelligent you all are. I had one person text me just said they like Leon's goatee. But anyway, the point is, like, we're doing this because we really do care. But we're also doing this because we're business people and we understand you can have a business and still serve your community at the same time. So we hope everybody watching, we received over 90 plus like invites to our group from other group members over the last 12 hours.
Yeah, well, now it'd be approaching 24 hours. Yeah, in the last 24 hours, members within the group have invited over 90 people. Yeah. And
I'm gonna say this: if a company if an organization is getting its members to invite over 90 plus people in a 24-hour period, you're probably doing something right. And I truly hope that those of you all who are watching this come over to the platform. And I'm not saying this because it's making us money. I really am not. I truly love helping people. And Leon loves helping people. We want to help as many as we can. That's going to be our mission, like to help as many people as possible understand the power of the stock market.
And it's not even us; it's the people in the group. Because I mean, like we had a bunch of chats today, a bunch of posts today about different stocks, about different investment strategies, about options. I mean, options is now becoming kind of a big thing in there. So
that was Beverly's brother-in-law.
Oh, okay.
Yeah.
Okay. So that's
she said she didn't even know he knew that much about options. So I mean, again, these things that you all are doing are starting to change how we build the business. And so you all are having a very immediate effect on how we build this business. And I don't know if we made the announcement, but Leon and I just got our EIN tax identification number yesterday. So that means we are about to hit that road where this is like a legitimate business, and we're going to start building out the membership platform. And we have goals planned for inside of that membership platform. It's going to be amazing.
It'll be good. It's going to be good. Yeah, it's going to be good.
Yeah. So with that being said, we got to give you guys what we owe you, and that's 2 stock picks. I can go first.
All right.
So I chose Tesla, and one of the things that I found did you pick Tesla?
Nah.
Oh.
I know we've done that before. We almost picked the same thing.
Yeah. So am I doing a screen share right now?
Say what?
Am I doing a screen share? Let me share my screen.
Not sharing right now, no.
Okay, so I picked Tesla. Now, this is something that's kind of me and Leon geeking out for a second. Leon and I looked at Tesla 3 days ago,
Mhm.
and it was approaching the $1,000 mark. And Leon and I were like, it's going to hit 1,000, and that's this resistance. It's going to go back down to probably somewhere close to the mean, and it under 1,000 was what we predicted.
Right.
It literally hit over 1,000. After hours trading is heading downward to the $1,000 point, and we think it's going to rebound again. But once it establishes itself over $1,000, it's off and running for Tesla. Now, let me tell you what's happening in the marketplace is very different than the market from before. And you all who visit or frequent these conversations with us know what I'm about to say. Stocks used to split to make them more attractive to everyday consumers. As the world is changing, so is the market. The market doesn't care as much as it used to. These companies aren't necessarily trying to split to make themselves more affordable to the general stock consumer. They're just growing. And it caused some people to look at this like, well, why would they pick a stock that's $1,025.05 for some of the people, some of our community are new to investing. People, you don't need stock splits anymore. You have fractional shares. It is the best leveraging thing out there. And also you have fractional shares where you don't even have commissions on the trade. So you can just dollar cost your average your way into the total stock price over time. But more than anything else, you can immediately get into the game. So you don't have to buy an entire share of Tesla, which is at $1,025 right now. After I'll just leave it at that. And you can buy a fractional share. Reason why I picked Tesla, as you all know, they recently launched another spaceship. And the thought was Tesla was comprised of Solar City, Tesla, and what was deemed going to be SpaceX. At some point, Elon Musk and his cousin, was his first cousin, I believe it was the head of Solar City. And they accounted for many of the solar panels you see on houses today. A lot of that technology that they use for Solar City and Tesla was being tested through SpaceX. So SpaceX has had a trickle-down effect into Tesla and Solar City that has been extremely profitable for the companies. Tesla realized that Solar City did not need to be a standalone business, so they absorbed Solar City into Tesla. Solar City, you cannot buy the stock anymore. I believe that somewhere in the future, you're going to see either SpaceX becoming like one company, or SpaceX is going to be a very, very closely related company to Tesla's success. Tesla's main manufacturer in China has recently come out with a battery that now will last I think like 16 years. And it's believed that this battery not only will last 16 years, but they'll be able to use it in additional cars. This is huge for repurposing equipment inside of cars. If they can now cut out what is their major cost was the batteries and now reuse them inside of cars, that means the manufacturing of new batteries isn't required. That means they don't have to get as many, the same amount of raw materials to create these batteries, which is going to drive production costs way down. And because you're buying a car now that has a longer life, you're going to be using their service department much more. And most car companies' money comes from services, not the initial sale of the car. This all puts Tesla into a very good place, in addition to the fact that their trucks now are like, I think production has increased maybe 10% or more. I mean, the request for Tesla trucks to hit the road, freight trucks that is, has increased. And this is something that's kind of new for them. So looking at the Tesla truck market, it's going to be a surge for Tesla, and they're going to keep growing. I think if you're watching this, I know it's $1,025. You don't have to get a whole share. You can get a fractional share. If you can get a whole share, you should. And this is one of those things too, like, you know, is it risk capital? I don't know. But can you afford to stay out of the market? Probably not.
No, you can't. There's no problem. No one can afford. Again, if you're earning 2%, 10, you know, and with the, yeah. So on Tesla, I like Tesla. And on the fractional share portion, just kind of give you an example is if you only have $100, then you buy 10% of Tesla. You buy 10% of one share. Very simple. It's the fractional share. Just take the whole and divide it up. And you want to buy half a share, you put up $500. So you can still, whereas before you were locked out of it. Now you can actually still get in the market, get in something like Tesla at, Brent said, fractional shares. Just take the percentage of the whole and break it down like that. My stock is a semiconductor stock. Stock's name is Xilinx. Ticker symbol is XLNX. Today it closed at $95.30. It was down 0.5%. Their biggest product is they make programmable chips. They service mostly data centers, wireless and wired, automotive industry, industrial industry, and aerospace defense industry. Their 2-year growth average profits is about 16%, and their 2-year sales average is about 14%. So
Leon, is this the right one? XLN is in Nancy X?
Yeah, that's it. Yep, 95.30. Yeah, that's it. Mm-hmm. Yeah, that's it. So they're programmable chip, and I can't say I have any love for this company. I just did my research on the fundamentals of it, and the primary reason why this is my second semiconductor company. And again, the reason why is because the semiconductor industry is the top industry over the last 5 to 10 years in the market. So I'm picking stocks in industries that are leading the market higher. I'm not looking for laggards. I mean, laggards can work. I mean, markets that are trailing. And then when I say leading the market, I mean they're beating the S&P 500. As we saw, S&P 500 does about 10% a year. That's the market. Where semiconductors over the last 3 to 5 years has done about 130%. So semiconductors are leading the market by far. So I like to pick stocks that are in markets that in sectors that are leading the market higher. So again, I have no love for Xilinx, but I know they're in a sector. They're in a sector that's leading the market higher, and I expect the returns to come, in the future.
Hey, Lee, what was the stock you picked? AVGO?
Yeah, Broadcom. Yeah, AVGO. Mm-hmm.
Yeah, so Broadcom, just for you all who Leon picked it a few weeks ago, they just announced their dividend payout is coming fairly soon in the next 2 weeks, and they're paying out $3.25 a share. The link to that article is in Investing Education Academy Facebook group. If you guys want to check it out, you feel free to go there. You can see it. But these are our picks. And again, if you're listening to our podcast right now, if you're watching us live, if you're watching the replay on our YouTube channel, we are doing this for you to create an actionable item for yourself, to change your mindset today, because the market won't wait for you. Inflation won't wait for you. And this gap, the ROI gap, is just increasing. And it's not even, I mean, we haven't even begun to talk about opportunities and, the gap there, but at least you can control your money and where you put your money. There's no guard standing at the front of the stock market saying, oh, no, not you. There's nobody like racially profiling you as you walk through the stock store. You can go into the market and buy what you want, and that is just all it is.
And with that, remember, there's absolutely no cost to getting in the market. It's literally, you can literally get into something. You can buy an asset that's going to, on average, return you 10% a year, and it costs you nothing.
It costs you the asset that you buy.
Yeah, well, I mean, the cost. Yeah, but I'm saying the entry fee.
Not nothing.
Yeah. There's no cost to buy that asset. But also remember now, it doesn't cost you anything to get into that asset. 1, but 2, again, if you do dividends, you're getting paid. Dividends are literally free money. Just for owning Broadcom, which I own now, I'm gonna make 4% on that per year, no matter what the stock does. If it goes up, great. If it goes down, my dividends will pad that loss, and then wait for time for it to come back. But I'm getting free money just for owning that stock. So again, we need to close that ROI gap, and dividend stocks is a great way to do it, because as I showed you, on average, you're going to earn 4% a year more than you would in dividend stocks than you would just buying regular stocks that don't pay dividends. So
for those of you all who are trying to go, well, why would I buy a regular stock at all? The appreciation is what you're really trying to get when you buy, a non-dividend paying stock. You're going for the appreciation of the asset. And for those of you all who are listening, the cost of the investment is the only thing that you're paying. So when you look at the cost, that's what you're paying. So I just want to be clear, for those who are just listening, they're like, it costs nothing, but
Right. It works. And yeah, good point. So what I'm saying about that, what I mean by that is, yeah, if you're buying a stock for $100, it's going to cost you $100. Before when they had, before when they had commissions, it cost you roughly $7 to get in and $7 to get out. So if you bought a stock for $100, your commissions were $14, what they call round trip. So your cost was 14% of the money you put up, $14. Whereas today, there's no cost. That 14% is now gone. That's in your pocket now that you can then put into the market. So that's what I mean by there's no cost. There's no cost to entry to buy a stock. Whereas before there was a cost. It was roughly $7 to get in, $7 to get out. But now there's no cost.
Yeah. So everybody, please remember, we'll be live again next Wednesday. And we have some really good stuff coming out for you inside of the investing education ecosystem. I'm excited about this week. I thank all of you all for the text, the emails. Leon and I share them all the time. We're like, it keeps us going. I mean, I'm gonna be honest, it's a rough world out there, and we're trying to do this is our part. You know, everybody is deciding what they're gonna do. We made the decision, this is what we're gonna do. And so we wanna do it in a way that is beneficial to you all. So if you have comments, if you have thoughts, you know, jump into the Investing Education Academy group and let us know what they are, or send direct messages, which many of you have done. And, you know, we look forward to seeing you inside of the Academy.
Yes.
All right. Enjoy your day, everybody. Thanks for sticking with us.
Peace.